Okay, let's go. Starting it now. Okay, guys. So this is going to be a quick video. I'm trying to keep this down to 15 minutes of a fib retracement tool that I created, and then I called the entry trigger and stop loss, ET for short. We're going to go over some rules really quick, and then we'll jump into the chart to show you some examples. So, rule number one. This tool must be used with confluence. So, I know everyone in here has different styles. I know mainly we're here for Elliott waves. So, confluences such as Elliott waves, order blocks, horizontal support slash resistance, your volume levels, if you use those, golden zones, Bollinger Bands, VWAPs, EMAs, RSIs, if you like swing failure slash liquidity trades or failed auctions. The point is, you need to understand the context and market structure and whether or not price is ranging or in a trending environment. Okay, that's rule number one. Rule number two, entries are only taken upon the retest of the 0.3 and the 0.25 fib levels, giving you the entry trigger. Rule number three, the 0.12 and the 0.05 fib levels are to be viewed and used as stop loss levels. I'll get into that as to why I say that a little later. Once the ET has been triggered, business above the ET is to be viewed as finished. Okay, so stats show that the 0.12 has a 5% chance of being tapped. All right, only after the entry trigger has been back tested. Now, the 0.05 has a 1% chance of being tapped, again, after the entry trigger has been back tested. That's a key point there. Only after the entry trigger has been back tested. Okay, rule number four. To use this tool, you must think backwards in order to properly reap the benefits of the tool. Okay, so if you are looking for shorts, you pull the tool from low to high, okay, and then vice versa. If you're looking for longs, you want to pull the entry trigger from high to low. And now let's get into some examples. I'm going to be using the 1 hour chart to keep things simple. The higher the time frame, the better. So that's another reason I'm going to start with the 1 hour chart. Okay. And we'll just begin with local price action. What's currently happened? Okay. So if we know, again, remember the rules, right? Context is important. Market structure is important. We are already down so far. Okay. I'm going to spoil it a little bit by showing you some of the stuff I already marked out. But what we can see here is we have a reversal off the top, right? We come down, we change market structure. We start to work our way down. We should not be looking for shorts while we're at the low. Okay, while we're at the low. Now, if you have some kind of count that you're looking for WXY or this is W, ABC back down, X, and then Y again for potentially, a bigger W, because we already see a mini one. But if we're looking for that bigger one, then, that's on you. So the thing here is, though, when you're at the low, you're not looking for shorts. So with that in mind, with context in mind, with how far we've already dropped, we want to be looking for long trades. In that case, what we do here and how we pull this tool, as I said, you want to think backwards when you want to use this tool. You have to think backwards. That you must. Okay. So how we pull it is, if we're looking for longs, we want to pull it from the high to the low, as I've circled here, each point that I've taken this pull from. Okay. What we're waiting for is for price to come up. Here you see it nicely because it comes up. We have the high, there's the low, price comes up, changes market structure with a tiny wick, and then it comes back down into our entry trigger, our 0.3 and our 0.25. Now, why am I shilling this tool? Why am I showing you guys this? The reason I'm showing you this is because I believe this will help take you guys to the next level. I believe this will help improve your entries and give you the best risk and reward possible every opportunity that you decide to take a trade. Of course, again, with confluence. So let's assume we take this trade right here off the entry trigger. Okay. First thing we want to be concerned about is risk. We always want to protect our capital. So as stated in the rules, the statistics say that I've taken, you guys can do your own statistics on this once you start applying this. But statistics say that once the entry trigger has been back tested, there's a 5% chance that it's going to come down here. So that means out of 100, it's only 5%. So meaning it's less likely to come down here and back test this 0.12 after this entry trigger has been hit. 1% chance it comes down to this 0.05 fib level. Okay. So with that in mind, we see our trigger hit, right? And now we need to set our stop loss. Most of the time, you'll notice that you can get less than a 1% stop loss in here. So with the stats in mind, we can either be, kind of, I don't know if you would call this conservative or tight. I mean, really, most people are going to put it below the low. But generally, what you'll notice is you'll be able to get away with 0.5 stop losses, a lot of times under 1%. Okay, so let's just go with that. We'll take the low of this wick here. That's a 0.37 stop loss. Okay, now you remember you're longing here. So what's your reward? If you took profits there, you have a 5%, 5.2% in profits. Now, price comes back down. Okay. And we can get into how I take profits on this a little bit more towards the end. Price comes back down here, right? Okay, so we're still looking for longs. Market structure is definitely not changed. Here was the initial one, right there. There was the initial high, okay? And then we broke it right there, okay? Market structure has changed. High, higher low, higher high, higher low, higher high. We're looking for a higher low, okay? This is what I mean by context and market structure. So we're still looking for longs, okay? So what we do is we pull the fib tool. We're looking for longs. We pull it from the high, as I circled here, to the low, as circled here. We wait for this back test. We wait for price to come up and back test the entry trigger. Okay. So why does this, real quick, we'll go over this. Why is this stop loss method so effective? Because it's this. Once price comes out of this zone to back test this entry trigger, business down here is already done. So there's no need for market makers, bigger traders to come back down here and do business down here. Okay. Same thing here. Why is this stop loss with the 0.1, 2, and the 0.005 so effective? Because once price comes back up and back tests this entry trigger, business down here is done. So you're not expecting it to come back down. Okay. So this is local price action. Now, let's look at this in the opposite light. Let's look at this in a short view. Okay, so here is, I don't like those so skinny. Okay, so this bigger one that I have here, I just moved the levels to the left rather than the right because we have others examples we'll go through right there. Okay, so I pulled this one. So I'm looking for a short because again, context, we're working our way backwards now. So we started with current price action. Now let's go to the local top. Okay, so we got to remember what just happened before. We were down here at this 15.8K range. Then we moved our way up to 25K. We're not looking for longs at 25K. We're not looking for longs anywhere in this region unless we have a reason. We're not looking for longs here unless we have a reason, right? Unless it's and what I mean by that is like swing trades. Okay, day trade scalps, that's fine. But swing trades, no go. So we want to short. So what do? We pull the entry trigger. We pull the ET from the low, which is circled down here, which is this little wick right there. That one right there, from the low to the high, right? And we just be patient and we wait. So what you'll see is price will reject, as we had the swing failure pattern here, right? We took liquidity, we took those highs, right, with the swing failure pattern. And from there, price rejected. Now we're just being patient. We're just waiting for this entry trigger. Price comes up. We still didn't get it yet. I mean, if you weren't, you got to remember, these are 1 hour candles. So you see 1, 2, 3, 4, 5, 6, 7 back tests of this. I mean, most people are probably going to take it, right? Which is understandable. So if that was the case and you did do this, because we have to be realistic, we're not going to act like every single time we get the ET, we get the perfect entry, because that's not going to happen. So let's just say you took it right here and you were very early. Remember what the statistics say about the 0.12 fib. Okay. Less likely that we're going to come back up here after we back test this. And what do? We didn't come back up here. Okay. And remember the stats on the 0.05. So if we took this short here early, our stop loss shouldn't have been just there, but we want to give it a little space to breathe. But this would be a case of, okay, maybe you get stopped out, because generally, like I said, we're not looking for 2% stop losses. We're looking for about roughly 1% to less than 1%. So This is up to your discretion whether or not you want to use the 0.12 as your stop loss, or you want to use the 0.5 as your stop loss, or if you're going to display extreme patience and wait for clean back tests, right? Wait for clean back tests. Now, this is so then you may be wondering, well, how will I know if price is just going to reject here and go down, or if price will reject and then come right back up? Well, hopefully you're good at Elliott waves and you have a count that can give you a warning about that. And that's all I'm going to say. This is very context dependent. Generally, this is not for beginners. This is for traders who already have a system in place. As I stated, use with confluence, rule number one. And it's up to you. Okay. So I'm just giving you what I created and the stats behind the levels of the 1-2 and the 0-0-5. It's up to you how you decide to use it. Okay. Now, let's say we get stopped out of this because really we want to use this tool for the best risk to reward. So we want to be generally around that 1% to lower. And essentially, especially if the 1-2 and the 0-0-5 are more than a percent away. So let's just assume we got stopped out, which is fine. So we move on. We take let's say we shorted here. We have a stop loss here. We only lose 0.7%. Okay, cool. Price comes up again, loses this level once more, and now we need to be aware that we've tested it once. We made another low. We made a lower low here, and then we come up. We take liquidity here, but we don't make another high. We don't take these highs. Let me get rid of this. We don't take these highs. So market structure really hasn't changed unless it comes down, holds a higher low, and then makes a higher high. That wasn't the case here. We found resistance 1, 2, and I would still count that as a 3. But we found resistance here at the entry trigger, which gave the drop. Okay, now you may be wondering, how come you have the 618 and the 66 here and you don't have them on any others? That's because here I have the original entry trigger, and then when I look for targets, I just throw in the 66. Now, why does the 618 and the 66? Now, why does it show a support here? Well, that's because you have to remember you're pulling it from the low to the high, but we're thinking backwards. That's why this gives you a perfect take profit, and you can pull this on any single one that you decide to pull on your chart. Right? Generally, the golden zone is a good take profit one. Put your stop loss to entry or in profits, and then let the rest ride. Okay, so this gave you 2 trades. This gave you the back test of the entry trigger, right, down to the golden zone where you take profit, right? Take profit 1, and then you had a trade set up right there for a long. Where did it go? Back up to this order block right here. Okay, right. I don't know if you can see that. Back up to the order block right there, 1 hour order block. If we go to the 4-hour time frame, nope, it was the 2-hour order block. So 2-hour order block, 1 hour order block hit right there back to the golden zone. Now,